So we're doing a monthly review on a $12 million 40-person restoration company. Let's see what we're looking at. So the three bottom lines first. So we have net profit, which is up from last month, which is fantastic. We have operating cash flow, which means they got even more cash in the bank than they ended up with net profit, which is great. They must have done a good job on collections. And then our return on assets, 6%, which is great. That's more than you would get investing somewhere else for the month. Sales, how much did we earn and where did we earn it from? So our total revenue is 1.246. We're up about $300,000 from January. So that is fantastic. This is a newer company to us, and so some of these charts only have 2 months on them, so they're not terribly informative, but that will improve as time goes on. So revenue breakdown, we have mitigation being their highest service line, and then rebuild, mold, and contents. So there's the breakdown there. Job category totals. So this is how many new jobs per category that they had this month. So our mitigation jobs are down slightly. Contents jobs are up quite a bit. And then our average, the value, dollar value per job. So we had some big recon jobs this month, it looks like, compared to last month. And everything else is staying pretty stable. MIT is up just slightly, which is nice. So now we're looking at our profit drivers. So our operating profit is $389,000. And how we got that is a combo of these things. So we have a total of 137 new jobs, and the average job value is $9,100. So our labor percentage is 28%, which we want to keep that under 30 if possible. It depends a lot company to company, and within the same company, the mix of product lines, how much of the labor is done in-house, how much is subbed out. So there's a lot of nuance that goes into this, but in general, at minimum, we want it to be under 30. So it came down from last month, and it is under 30, so we're happy about that. Our COGS percentage, so this is made up of our labor plus other things like materials and supplies and service vehicles. We want this to be under 40, so this is a little bit high. We're not loving that. Our marketing percentage is 5%. We expect to see that around 5 or 6, so that is just fine. Our overhead, we want to keep that under 40, and in this case, it's quite a bit under. So it's nice that that makes up for the fact that our COGS is a bit high this month. So that's how we still end up with a nice net profit at the end. So what's left over? So we have our gross profit margin. We want that to be above 60, although it's close. But we want to keep an eye on that for next month. Our operating profit, we want that to be 21, 22, and it's over that, so that's fantastic. And then our net profit, we want to keep over 20, and it's significantly over 20. So that's great. We're happy with our profit for the month, our profitability. And then here are our profit margins. Our gross profit is just a little bit lower, and our operating and net profit are up from last month, which is great. So what did we earn from operations this month? So here's our revenue on this side. And then, so it's all the money coming in. We have our cost of goods sold, which is our labor primarily, but then also materials, supplies, service vehicle expenses, everything it takes to physically go out and do these jobs. And that leaves us with our gross profit and our gross profit margin. And then we have our expenses. So this is our overhead. We have our overhead listed here. And so that leaves us with our operating profit. Be more careful not to cover up the numbers. We have left our operating profit margin. And that gives us our EBIT number here. So our net income margin, this is great. If we can keep this up, there's a lot of money to do the things that come after this, like paying our interest, paying down loans, things like that. So our net profit is up from last month, which is fantastic. Here are our assets. We see a big shift in cash in the bank, primarily, from January to February. That's that extra $530,000 that we got in cash. That's where we see it show up. So that's fantastic. Our accounts receivable is down just slightly from last month, which is notable, although not very much. So our return on assets is great. Our cash position is up significantly. Our efficiency, did we deliver efficiently, and are we optimizing our operations? So we want this revenue per tech number. Again, it depends on company, it depends on the service, specific service line that we're talking about. But we want this to at least be 50 or 55,000. So we love that it is up at 62. And then revenue per admin, we want to be at least 65 or 70. And we're right there. So that's great. Job acquisition cost, it's up $80 from last month, although it's still not concerningly high. So this means for every $429 spent in marketing, we got a job, and those job values, the average is $9,100. So that is a reasonable price to pay for those jobs, because those jobs are pretty large. What we received and what we spent. So here are our top 10 COGS expense numbers, and then our top 10 expense or overhead numbers. And it's primarily labor. I mean, this is labor, this is labor, this is labor, this is labor. And then over here, our biggest overhead expense by far is labor, which is what we are used to seeing in restoration. So here's our common size P&L. So this just looks at, here's our revenue, and then of that, what percent are these things? So our COGS labor, here's our 28% of the revenue number, etc. So our total cost of goods sold is 40.6% of our total revenue. And then same thing down here, our total expenses is 28% of our revenue number. So that is looking great. Our expenditure mix, so we have our COGS, we have our fixed expenses, and then our operating profit is this bit left, which is fantastic. Because like we said, that isn't it. You don't get to keep all of that money. So profitability is one conversation. A different conversation entirely is cash flow. And oftentimes owners have a really good eye on the profitability portion, but they aren't keeping an eye on cash flow. And so it really creeps up on them, especially if they're growing. They're starting to get really low on cash, and they run into problems before they notice, because they're profitable, so they think it's all going to be fine. But unfortunately, those aren't all the things at play as far as cash flow is concerned. So this month, though, we have an excellent cash flow. Our accounts payable days are nice and high, which is great. We want our accounts payable higher than our accounts receivable days. If you can arrange that, the owner isn't having to put cash into the business as the business is growing, because we are getting those revenue dollars before we have to pay the expenses. Too often, though, those are swapped, and then the owner is having to put in extra cash to fund the growth, which is not what we want to see. That's when we run into cash flow issues. So we had AP added this month rather than paid. So that helps us know that, on one hand, we have more bills that we're now on the hook for. But on the other hand, it's been great as far as cash flow is concerned. Our accounts payable days are down from last month, although since last month is when we onboarded, I wonder if we're counting things differently than we were previously, because this would have been a really high AP days. Being up at 67 is already pretty darn good, or 66. Our accounts receivable days, though, unfortunately, are higher than we would like, and they are one day higher than our accounts payable day. So we want to keep the accounts payable days as high as they are, but we would really love to get this lower. That is not helping us out. So basically, the owner would have to somehow infuse cash into the business to cover one day. We are paying out our expenses on a job one day sooner than we are getting the revenue in the door, in the bank, which one day is not bad, but we'd love if we can get these account receivable days down to 45, 50. Even lower is better, but sometimes it's not possible. So we have an AR decrease, and that got cash into the bank, which was fantastic. Our revenue growth rate of 38 is fantastic. We love that. Sales is up significantly in February from January. Our AR growth rate being down is a good combo. That's how we have so much cash, is because our AR did not go up, even though our revenue went up. Okay, and here's our accounts receivable days. They are down, which is good. We want them down even further if at all possible. these things are pretty small numbers. They're not very significant. So we sold $5,500 worth of assets. So that added to our cash. We repaid debts. This is probably principal on the SBA loans and the vehicle loans. So this is how much our debt repayment, it hurts our cash. So on one hand, of course, we like to repay our loans. It's a great thing. But it helps some of our, in fact, it helps some of our KPIs and things like that. But at the same time, it hurts our cash because it's just cash that went out the door. So that is a small number, so it didn't impact us too much. So that's fine. Owners aren't taking anything out or putting anything in this month, which is just fine. So this is how much more money we ended up with in the bank than we had at the end of the previous month. So this chart is great. So this is showing us the cash received that went into the bank. This is showing us the COGS money that went out. This is showing us the overhead money that went out. And then that is the primary difference. We get cash flow back because our accounts payable went up. My pen is not working. And then we get money because our AR got collected. So that's fantastic. And then everything else down here is very insignificant numbers. So at the end of the day, we ended up with approximately this much more cash, which is fantastic. So what we owe, this is just a look at our balance sheet, the liabilities section. Nothing too significant has changed there. Primarily accounts payable. This accounts payable going up is what has changed. Other than that, it's pretty minor. And then, yep, here's our 9,000. Here's our 5 and our 4 that were paid out. What's ahead? So here's our revenue forecast. What sales we project quarter over quarter. And then here's what is actually happening. And this part down here is the actuals. And then this is what we're projecting. Operating profit. So our operating profit is going up as well. And then with how we've chosen to forecast it, we see it staying flat. And as things change and adjust, we can always add new pieces of information to adjust that. This growth analysis, because this is only our second month, we have only a dot on the map. But the revenue growth itself is great. We have 38% growth over last month. The chart itself is not very impressive, however. Revenue growth, 38%, fantastic. Operating profit growth is great. We must have lost money last month. What portion of revenue turns into usable cash? So let's see. So here are our EBIT, earnings before interest and tax. And then the bottom line is our total operating investment. So we have operating investment at 3.66. Our EBIT is 392,000 this month. So that's fantastic. This is the quadrant we want to be in. We want to be in this quality growth. Efficiency gains isn't too terrible, but quality growth is ideal. And so from our starting point of last month, we've gone exactly the direction we want to go. So that is phenomenal. Break-even analysis. So our total revenue, 1.246. Our break-even margin of safety, $663,000. And our expenses to revenue ratio is great this month because we want it to be above 60. And in this case, we're looking great because our overhead was pretty low this month. So this is what this shows. So this is the amount that is our overhead, this area here. And so as we start doing jobs for the month, we have to pay our overhead. And in addition, we have to pay all of the cost of goods sold expenses to cover the cost of goods sold for the amount that it took to also cover our overhead. Basically, what this is saying is for every dollar that we get above this point, this break-even point, we get to keep 59 cents on the dollar from there on out. So every dollar that we earn, we over this $663,000, we get to keep 59 cents on the dollar, which is fantastic. And here we have our KPIs chart. So our total new jobs is up from last month. It's great. Average job value is up from last month. See if my pen will let me do check marks. No, it will not. Let me circle though. So odd. Our new mitigation jobs, new mold jobs, contents, recon jobs. The average job value by category. Our labor percentage is down slightly, which is great. Our COGS percentage is up. Marketing percentage is just fine still. Operating overhead percentage. So our total revenue is up. We talked about that with sales. Our gross profit margin